Good afternoon, everyone, or good morning. Welcome to today's Market Update webinar presentation. Today's session is entitled Quarter 2 Investment Update and Financial Considerations, and it is a 1-hour session that will be hosted by Debbie May and Alex Seleznev of Counselor Buchanan & Mitchell and May Barnhart Investments. Debbie May is an Executive Vice President of Counselor Buchanan & Mitchell. She leads the firm's financial planning practice and is co-founder and chief investment officer of MBI, CBM's investment advisory subsidiary. Debbie has 30 years of experience providing comprehensive financial planning and investment advisory services. She is a certified public accountant, a certified financial planner professional, and a certified divorce financial analyst. Ms. May has also been recognized 9 times by Washingtonian Magazine for her financial advisory expertise throughout the Washington, D.C. metropolitan region, including most recently as a top financial advisor in January 2021. And she was quoted in a Washingtonian article this month about the potential impact of a Biden administration tax plan on D.C. area individuals and businesses. Alex Seleznev is a senior advisor and portfolio strategist at CBM and MBI. He's a certified financial planner and a chartered financial analyst who leads the firm's investment management division. Alex's focus is on comprehensive financial planning and investment management. In addition to today's market update session, Alex has presented most recently at CBM's February 9th session entitled How to Choose a Financial Advisor, Strategies to Help You Make the Best Choice Possible, and the February 23rd presentation entitled Medicare and Medicaid, What Should I Know Now and in the Future? He was quoted in Kiplinger's article about searching for yields in a low-yield market, and he's speaking with the magazine currently about another upcoming article as well. So you may want to check that out when it's published. Thanks once again for joining us. Please, as a courtesy to our presenters, keep your video off. Thanks also to those of you who presented or submitted questions in advance. Those have been shared with our presenters. If you have any other questions during the session, please feel free to use the chat box. The session is being recorded, and presentation slides will be sent to all attendees after the session is over. So thank you once more, and I will turn this over now to Debbie and Alex.
Thank you, Joe. Appreciate that. I want to thank you guys for attending today, and I hope everybody is well, and I hope you're looking forward to more activities this spring and summer. So in any case, MBI, just a little bit about us. There are 7 of us that are fully dedicated to investment management and financial planning as part of MBI. 4 of us are advisors, 3 are financial analysts. We are fee-only fiduciaries, and we're fully independent. We are managing right now just under $300 million on a discretionary basis and another $400 million approximately under advisement. So today you're going to hear about the market update. That's our primary focus today. And then I'm going to talk a little bit about financial literacy, which this happens to be Financial Literacy Month, this month of April. So with that, I will turn it over to Alex.
Thank you, Debbie, and again, thank you everyone for joining us today on this, I would say, beautiful day, at least here in Maryland. This is our second mostly investment webinar for this year. We try to do this every 2 to 3 months to keep everyone updated on what's happening in the market, in our current thinking. But what we usually do, we try to start with something that is, funny, or at least we believe is funny, and something that represents perhaps where we are in the market as of now. So in this particular case, here's this gentleman, and apparently his only form of exercise these days is chasing yields. Well, first of all, where we are at this point with vaccines and everything, luckily, there are many other forms of exercise that are available. But for those who are, engaged in chasing yields, as thrilling as it may be, and in some cases, perhaps even in many cases, it usually does not end well. So if anyone is participating in that activity, well, perhaps you should look for a more conventional way of exercise. And of course, we'll talk about this more throughout our webinar today. So as always, to update everyone on where we are in the market in terms of the year-to-date performance, the figures as of essentially as of yesterday, and not much really changed over the past 12 hours or so. So in terms of the domestic large cap stocks, pretty healthy increase of a little more than 10% for the year. Domestic small cap stocks are up more than 11% for the year. And what's interesting here, the rally that actually started post-election, meaning the beginning of November of last year, it's still intact. And actually small cap stocks for that specific period of time are up more than 60% compared to large cap stocks that are up only 25% for the same essentially 6-month period. In terms of developed international markets, they're up 6.5% for the year, predominantly European economies. Emerging markets that were actually one of the best performing stocks, especially of Asian economies last year, slowing down. So the emerging markets are up 4.5%, close to 4.5% for the year, but many stocks, specifically of Chinese companies, are actually flat for the year. The reason I'm mentioning that is because those stocks tend to represent 30 to 40% of the benchmark. Now, one of the perhaps most common questions or comments we've been making over the past couple of months or so is about bonds. So bonds are actually in the negative for the year. Bonds as a group, but actually many, I would even say most categories, by roughly 3%. As a reminder, they were up quite nicely, almost 7.5% last year in 2020. So why did that happen? Do we expect that to continue? Well, at least we can partially answer that question by analyzing what happened with the 10-year Treasury. And for those of you perhaps less familiar, mention two things. There is this inverse relationship between the bond prices and interest rates. And then in terms of the 10-year Treasury, that is considered to be the benchmark for the market interest rate. And by the way, the Federal Reserve Bank, they can control short-term interest rates, but they have very limited control over longer-term interest rates. And that's why the 10-year Treasury is used so frequently. So we started the year at 0.92%. Goes without saying, it's a pretty low rate. We finished the quarter at 1.75%, which by itself is perhaps not all that large, but that represents almost a 90% increase over a very short period of time. And again, as I mentioned earlier, there's this inverse relationship between interest rates and bonds. Why did that happen? Well, there are two ways of thinking about it. One of the reasons is, as we'll discuss later today, the economy is expected to actually improve quite significantly. And as a result of that, more and more people are expecting to see more inflation. Now, and the difference in opinions, some people say, well, a lot of what we're expecting to happen is already essentially priced in, is already reflected in this increased interest rate, and perhaps that's where we're going to be at that point. But there is a separate group that are basically saying that this is just the beginning. And in some sense, regardless of where you are with your thinking, this is something that we should be paying attention to, and we certainly do. In terms of the sector performance, in some sense, it's the opposite of where we were last year. Energy and financial stocks or companies are leading the way. And both of those categories, specifically financials, actually are very cyclical. They tend to perform best when the economy is improving or perhaps expected to improve even more. In terms of, those are on the bottom, but still in the positive, consumer staples and healthcare. They're up 3% and 7% respectively, and both of them are considered to be more conservative sectors. So, one way of thinking about it, the market is quite aggressive at this point. In terms of our overall outlook, we remain cautiously optimistic for the reasons that, again, we'll be discussing throughout our presentation today. That said, though, we haven't had a single market correction for the past 13 months, essentially since March 23rd of last year. That's when the market essentially hit the bottom. There's a reason you see an asterisk there. Actually, the NASDAQ, which is more of a technology index, it was down more than 10% last month, which is considered to be a correction, but it only lasted 3 or maybe 4 days. So it's more of a technical correction than anything else. Since then, by the way, the index pretty much fully recovered. And on average, we are expecting 2 to 3 corrections each year. So yes, there is that expectation. So we need to be prepared. In terms of the earnings season, which just started actually last week, financials are usually the first ones to report. The results, they've been mostly positive with a couple of exceptions. And in terms of the consensus estimate for the year, for the entire 2021, the earnings are expected to increase by 28% compared to last year. And you see, from our perspective, it's not surprising to see that to a degree, but if you looked at it at the end of last year, it was mostly in mid-teens. Then it kept going up, high teens, low 20s. Now we're almost at 30%, so the expectations are going up. In terms of the annual rate of return for the S&P 500, which is again one of the most common benchmarks, depending on who you read, depending on the analyst or economist that you're following, the estimates are somewhere between 8 to 14%. I haven't seen anyone saying that 2021 will be a negative year, not a single person, frankly, but I also have not seen anyone saying that it's going to be over 20%. What's interesting in this range, by the way, this is pure math, the market is already at 10%. So if you believe that we'll finish the year at something like 8 or 9, in some sense that implies that the second part of the year will actually be either flat or maybe even negative. So I would not be surprised if these estimates are revisited at some point, perhaps in near future. In terms of the economic conditions, well, we do expect the current relatively rapid economic recovery to continue throughout the second quarter, most likely the third quarter of the year, perhaps even throughout the entire year. There are 3 major drivers behind it. There are, of course, many other reasons as well. Well, rapid distribution of the coronavirus vaccine, especially in the United States, and we have a separate chart on that. Of course, the Federal Reserve Bank, the expectation is that their existing, essentially easy money monetary policy will remain in place for a while. They're trying to keep interest rates low, and they continue to pump $120 billion of liquidity into the system. And of course, I'm sure many of you heard of Mr. Biden's $2.3 trillion infrastructure bill that happens to represent almost 10% of the US GDP. There are some preliminary ideas of what that would look like, but of course the vote will actually happen in the middle of the summer. So we'll most likely have a webinar, some kind of commentary just dedicated to that. But again, once you look at all 3, well, yes, all of these factors are positive for the stock market. And in terms of the US GDP, well, we are expecting actually one of the best growth rates since actually early 50s. Last year, of course, was a pretty bad year, a decline of 3.5%, actually the worst since 1946. For this year, what's interesting, again, back to expectations going up, the Federal Reserve Bank, or the Fed, their previous estimate was only 4.3%. The most recent one is at 6.6% for the year. In terms of the private economists, current expectations are at 7% or higher. And again, previous, meaning earlier this year, they were between 3.3 and 6%. Now, inflation. So in some sense, finally it happened. Currently at 2.6%. And there's a couple of reasons why this is important. This is the highest rate, at least as measured by the CPI, by the Consumer Price Index, that we experienced over the past several years. And this is for the past 12 months ending in March of this year. It was at 1.7 as of February. Now, the Fed is targeting 2%. They've been saying this for a while. That is their inflation rate, but they will allow it to moderately increase above the target with the goal of ensuring that the economy continues to recover. And in terms of the unemployment rate, they want to hit the 3.5% mark, which is considered to be full employment. Now, many people question their ability to control it this well. but perhaps they'll be able to do so. Again, in any case, for those of you who have heavy allocation to bonds, we'll have a separate slide to that. This is something to pay attention to. In terms of the unemployment rates, they continue to decline. You know, the official numbers at 6%, 6.7% in December of last year. And of course, in the very, very middle, I should say, of the pandemic, it was at 14.7. Now, the unofficial figures, and they're published, you know, quite frequently, the unofficial figure is actually at 10%. And the reason perhaps we should be paying attention to it is because it includes people who are discouraged. They're not necessarily looking for work, even though they're capable of working, or perhaps they're waiting for a better deal. Perhaps they lost a job that you know may never come back. It also includes people who are taking care of their children, and as a result of that, they're not necessarily able to work. And actually, in this particular case, there was this interview. Janet Yellen was the one who specifically pointed that out, that yes, there's an improvement in the official numbers, but the official figures are not necessarily improving all that much. So again, perhaps it would make sense to pay attention to both. In terms of the vaccinations, something that I touched on earlier, of course, this changes on a daily basis. This particular chart is as of Monday. The US leads the way in terms of the first dose. I want to make that clear compared to other large or developed economies, specifically European Union. I was actually a little surprised by the figures in Asia, only 3.5%. That was just a little surprising to me. And for those of you who are curious, in terms of full vaccinations, actually Israel is leading the way at more than 55% of the entire population fully vaccinated. In terms of the US GDP growth, and we talked about this, notice that over the past essentially 3 decades prior to 2020 was consistently below 5%, in many years was significantly below 5%, compared to 50s, 60s, 70s, when it was, I would say, consistently above 5%. So if we actually hit that 7% mark, or perhaps even lower, well, yes, it would be one of the best growth rates since the early 50s. In terms of the CPI, again, something I wanted to point out, there are 2 ways of measuring it, but we actually mostly pay attention to the blue line that includes all items and actually services that are part of the CPI basket. Notice that in May of last year, again, in the middle of the pandemic, we essentially had no inflation. It was at 0.2%. Then gradually it began to go up and up, and we're now 2.6% again as of March of this year. The second measurement excludes food and energy, and it's used for rather different purposes. But again, for most people, you need to eat something. Most people do use energy, so we usually pay attention to the total CPI. Now, in terms of the asset class returns quilt, some of you know this is actually one of my favorite charts to discuss. Again, it shows you the performance of each major asset class by year from 2011 all the way to year to date. So 2020, we talked about that in our previous webinars. Not going to focus on that much. Large cap domestic stocks were the best performers, and then commodities as a group and real estate, in some sense for obvious reasons, were the worst performers last year. Notice how different it looks, especially for certain categories this year. And by the way, this is as of the end of last quarter, so somewhat different from what we discussed earlier. So small cap domestic stocks continue to lead the way. Real estate as a group, as measured by the Real Estate Investment Trust Index, so publicly available real estate, is recovering quite nicely from the drop in 2020. One thing, and I actually looked into this, only a little more than 20% of the index is in commercial real estate. So it's mostly on the residential side and industrial. Mid caps are up 8%. Commodities are up almost 7%, specifically wood, prices of wood and oil. Gold is actually down for the year. Large caps, 6%, closer to 10 at this point. One of the perhaps surprises, it shouldn't be surprising, but balanced portfolios are closer to the bottom of this list. And again, balanced portfolios are those that have 60% in stocks, usually 40% in bonds, and usually on the stock side, they're mostly in large caps. That's how a typical balanced portfolio is constructed. So notice is it's only at 2% versus, again, other asset classes. Emerging markets are up 2%. Cash alternatives are, of course, flat with interest rates being this low. And again, domestic bonds are down or were down 3.39% at the end of last quarter. Two things to observe here. The benefits of diversification. Notice how different asset classes, how differently they can perform in various years. And also, perhaps, something to notice, but not that obvious, that certain asset classes do not trend as much. Look at emerging markets and small cap stocks. They tend to be either on top or closer to the bottom compared to, let's say, large caps and mid caps. And of course, there are some years when you would see a couple of years of good performance, but usually they do not trend as much. And that's important. Again, I'll explain why in just a moment. In terms of the sector rotation, so for those of you who are paying attention to financial media, at least to some degree, it's been all about this so-called rotation from growth to value. And again, growth stocks are usually, technology, consumer discretionary. Again, they're growing their revenues usually at 15% annualized or more, usually in less mature industries, and usually do not pay dividends. On the value side, in some sense, it's the opposite. Manufacturing, financial companies, usually again in more mature companies. Just a moment. So again, 2020 was all about growth. The first quarter of 2021, it's been all about value, specifically mid and small cap value stocks. So again, that's a perfect representation of this rotation. Now, in terms of our investment strategy, for those of you who are invested in mid and small cap stocks, and on our end, it would actually be a good number of our clients in those types of investments, we do suggest that you rebalance and actually take some gains off the table. Some of the reasons, again, they're pretty high point at this time, and they do not trend as much. When you're rebalancing and assuming that you want to keep it in domestic stocks, we'll consider large cap value. And there are actually options that would include more volatile options such as energy and perhaps core options such as healthcare. So healthcare is usually in that core category. Now, one of the things that we've been saying, I would say for a while now, for a couple of quarters at this point, is if you're heavily invested in bonds, and let me define that. If you have more than 30% of your portfolio in bonds, make it 40, maybe 50%, look at your options. Revisit new purchases, revisit what you have in place. How will this portfolio perform if interest rates continue to go up? The yields are already low, by the way. What would happen if inflation continues to go up above 2.6% to something like 3.5% or maybe higher? Perhaps none of this will happen, but discuss and revisit your options. If you need to stay in fixed income, well, that's fine, and that's perhaps appropriate for you. Focus on shorter term options, meaning those that have maturities of usually 4 years or less. And by the way, in this improving economic environment, below investment grade bonds, the certain categories, may not be such a bad choice for you. Again, with longer term bonds, you have limited yields and their return potential is quite limited. If your risk tolerance allows for it, consider dividend paying stocks or actually preferred stock. Both categories, chances are, would actually pay you more in terms of dividend yields. And there is some, opportunity for appreciation. But of course, the volatility of your portfolio will likely be higher. On the international side, again, back to emerging markets, they do not trend that much. Usually, at least they haven't been in the past, and they're more volatile inherently in a sense. This may not be a bad time to take again some gains off the table. And if you want to maintain your international allocation, consider developed usually, European markets. What's interesting about European markets specifically, their economy is very different from what we have here in the United States. It's much, in terms of their public stocks, much less heavy in technology and much more into banking and manufacturing. That's just how their economy is in general. So in some sense, they would benefit from the same factors that we've been benefiting here in the United States. And then finally, if you have a financial plan in place and perhaps you're comfortable with it, well, stress test your assumptions. It's been, essentially 13 months since last March, when the markets were down more than 30% or so. And yes, perhaps some people are becoming somewhat complacent. Their portfolios keep going up, up, and up. Stress test your assumptions, rebalance, make sure that you would still be comfortable if/when we see more market volatility. And with that, I'll ask Debbie to discuss some of our financial planning ideas.
Okay, thanks, Alex. Do we have any questions on the investment side? We want to address one or two of those now.
Absolutely. Sure, let's do that. Here's one. How frequently, this is from one of our existing clients, how frequently should these investments be reviewed? Just had my investments reviewed, but I know I waited too long this time. Is there a market trigger that would instigate a review, or just general life events that change? ? Thank you. So what do you think about this one, Debbie?
Well, first of all, MBI, when we're managing on a discretionary basis, we're looking at performance at least monthly, and we're rebalancing at least, I would say, quarterly, semi-annually, and maybe a quieter time. Because when you're looking at rebalancing, it's also, as Alex pointed out on that quilt, it's all the various categories that are changing, and you want to maintain the percentages. Also, if there is major market volatility, you probably want to jump right on that. Like back in March of 2020, we were looking at harvesting tax losses, reinvesting, getting some of the monies from the fixed income into the market when it was lower priced, and there's those kinds of things. Of course, your own personal situation should always be revisited. And so if you're doing this yourself, or you're having us review on an hourly basis and giving you advice that way, be careful that you're really doing it in real time, because that's one of the dangers, is that you have something reviewed and then it takes you a few months to act on it. And we do suggest, if you're doing it that way, to at least be doing it semi-annually.
Well, thank you, Debbie. That's a perfect, you addressed it perfectly. I will just stress the idea of doing it in real time, or as close to that as possible. And again, the chart I showed you earlier is a perfect example of that. Things can change, and they've been changing so drastically over such a short period of time. So sometimes you look at it in the beginning of the month, and then at the end of the month, it looks almost entirely differently. Yeah. So doing it in real time recently, it's been really valuable for many of our clients.
Right.
Here's a second question. I would say more of a technical question, but I guess it's related to what we're discussing today. Quickly cover RMDs and how to instruct the IRA vendor to make some of the RMD payable to multiple QCD qualified charitable organizations. Vendor's instructions is to name the QCD recipient for the check, but they will only mail to my home address, and it's then my responsibility to get it to the charity. Will that break the chain of write-offs for the taxes? Thank you. So very good question, a little bit of a technical question. We work with Schwab Institutional. We're not affiliated with Schwab Institutional in any way. They're essentially our custodian, but as a result of that, of course, we have to follow their procedures. So when we make those, QCDs, basically, that's when you direct a portion of your required minimum distributions to, qualified charity. The check has to go to the address on file, which is, in this case, would be your home address. And then it's up to you to take the check and mail it to the charity. I cannot speak for every single, financial institution in the nation, but from what I hear, most institutions want to do it this way. I personally called them, it's been a while, maybe 3 years ago, and I asked this question. I was like, would it be so much more convenient for our clients if you just send the checks directly? And the response was, there are thousands of different charities. And if we start mailing directly to them, essentially, the institution, in this case, Schwab, would be a potential liability for them. But to address your question, it does not break the chain. So when you get your 1099 form, you would send it to your tax preparer, and then you would specify that, look, let's say 50,000 out of my, required minimum distribution went to these charities, and it would be reported as non-taxable on your tax return.
Right. And just to add to that for a second, the required minimum distribution is when you're, in the past, we're 70 and a half, and you're required to start taking out a distribution from your retirement. And some people, it's been very helpful to just directly send money to the charity because they otherwise weren't getting a tax deduction for it, but they're able to take it off the top and not report that portion of their distribution. So that's been very helpful for people. Now it's age 72, by the way. The required minimum distribution for taking money out is now age 72. Correct. So those are good strategies when you're in that situation. Is there anything else, Alex?
Well, here's actually one question from the chat box. And by the way, do not be afraid to ask questions in the chat box. We will not mention your name. So if there's a privacy issue, we'll read your question out loud, but we'll not mention your name. Any thoughts on investments in cryptocurrencies? So would you like me to cover that, Debbie, or do you have any
right ahead.
thoughts? So our position on that remains essentially unchanged. We had a similar question in our previous webinar. They're becoming more and more mainstream, and of course we're paying attention to those types of investments. As of right now, based on our client base, and usually more on the conservative side, there's just not that much demand. I know we have some clients who invest in them directly, not through us, but they open separate accounts to do it. We don't necessarily have a problem with it, as long as people understand that this is mostly done for speculative purposes. Again, I have no issues with speculation personally, but there is at least to me, there's a distinction between investing and speculating. And as long as people are comfortable with that, that's perfectly fine. To be specific, if you're comfortable with the value of your asset going up and down 5, 10, 15%, sometimes on a daily basis, well, perhaps this is something for you. And then here's I guess more of a clarification comment. I had several questions about DAFs, donor advised funds, out of RMD QCD this year. This is not possible allowed. So, Debbie, do you have comments on this comment?
I don't understand the question.
I'm also not sure if I understand. So you cannot take your required minimum distribution and put in your donor advised fund. No. If that's the question/comment, that this is our response. So by the way, with donor advised funds, a little bit outside of what we're discussing today, but very beneficial. Essentially, what you do for those of you who are perhaps less familiar, you would take your appreciated stock, preferably highly appreciated stock, and you would transfer it into your donor advised fund. The benefit of that is that you can take the deduction for the transferred shares in 1 year, right? But then you can actually distribute to the charities in the future year for as many years as you would like.
Right, very simply. And so that's a great idea when you're below the required minimum age, that you're not taking distributions. That's another vehicle that you can use to get in a very high or a higher upfront deduction, sprinkle it out over as many years as you'd like, and that will push people generally over the standard deduction if that's what they're dealing with.
That's right.
Okay.
So, are there any other questions? Please type them up.
Yeah, just put them in the chat box. So I will move on to financial literacy. This is a subject that I'm very passionate about. And in fact, in 1996, I wrote an article on teaching your children financial literacy, and did it, really from small children all the way up to adults. That was 1996. In 2004 is when the National Financial Literacy Day came to be in the United States. So that was 8 years later. So now we have that. And probably a lot of people don't even know about it, but it is April of every year. So 1998, I was asked to speak to police unions out in Las Vegas on financial planning and money. And my son, who was about 6 at the time, I was trying to explain to him what I was going to be doing and talking about money to them. And they're like, he's basically thinking, I don't know what you need to tell him. Just tell him to spend it. That's what I would do. So then I realized I needed to do a little bit of work in that regard in terms of teaching him. But what you're looking at on this slide is a picture of my son, roll forward to 2021, and his fiance, and they're due to get married this coming summer. I was just talking to him literally yesterday. He's very anxious to buy a house. And of course, we all know what the market's like, and he's in California, so it's kind of just as bad as here, if you will. And we were discussing mortgages and down payments and his income and making sure things were stable, and he liked where he was going to be living and how long would that be, and kind of realized that probably wait another year. And he said to me, Mom, you've always taught me about delayed gratification. So I thought that was interesting. I kind of even forgot that term, but that, you know, when you're educating, I think, young adults about what are you saving for, and that it can be rewarding, I think it has to be very tangible. And what I mean by that is you can't just say, save your money for a rainy day, save your money for something in the future. I just advise that it really become very tangible to them so that they can see the money growing and they can think about that thing that they're going to buy or what they're saving it for. And frankly, I think that's true with even older adults. When you talk about, let's save for your retirement, it's obviously competing against what you can spend today. But over time, you start realizing retirement gets closer and closer. And there's some other ideas I put here, like maybe matching part of their savings. A lot of young adults, even in college and whatnot, have part-time jobs, and they're allowed to have Roth IRAs if they have any earned income. So that's, I think, a great gift or a great idea for them to be contributing to, because we all know the benefits of Roth IRAs growing tax-free. Some of that money can even come out for first-time home buying. And then I talk about a 2-bucket approach, you know, for this age group, which means there's 2 things you can do with money: spend it, save it. And every time you get money, to have that concept of some of it should be saved. It's not even 50-50, it's something, so that they understand every time you get money, it's not meant to be spent in real time right then. Giving a stock, for example, it gives them the idea, it gives them the concept of watching a stock, all of the parameters that go around a stock and the things that you need to know about it, reading annual reports, whatever, you know, something that they're interested in. And then I say coming to meetings with your advisors, meaning your advisors. So if you're meeting with your state attorney, your accountant, financial advisor, I think it's a great idea to bring young adults. They can observe. They can be a sort of a reporter and take notes. They can ask you questions afterwards. So to the extent that it's comfortable, I think it teaches them how they can interact in that regard. Sometimes they do come with our clients at MBI and they have questions on their own. So I think that's a great idea. I also just mentioned quickly medical power of attorneys. I had this happen to a client, unfortunately, where their adult child, who was only 19, was injured, and the parents were not able to interact with the doctors. They were out of town or get any records because they were an adult. So it's really, I think, important to have a medical power of attorney on file, you know, if you want to be able to, you know, help them in that regard. Next slide. So then we get into couples actually married, having babies. I think for this group, I really recommend that they prepare their own tax returns. I've had clients over the years that are still having us prepare their kids' returns, and I do suggest that they take a stab at it, a draft of it. We review them for people so that they don't get it wrong, but that they can start to understand the implications of a tax return, and also that they read their, if they're working for a full-time employer, that they read their employee benefits book and understand it. It might be something you can sit down with them with and understand, what is an HSA? Why am I choosing this particular health plan? Should I be in this, in the 401k? Should I be doing this? Do I have matching? All of those things. I'm often surprised that people don't know what they have at work, or they're not participating in things that they probably should be participating in. Some benefits are just free, especially when you get into matching and 401ks. And then protection from life events. This is pretty much all about insurance and having a will. But I do find that young couples, when they have a small baby, like we're looking at here, that is the biggest risk that they have.
Right.
At that time in their life is the younger they are, and and how many years would a spouse or a child need support from you. That's where you need a lot of life insurance, and I think younger couples tend to shy away from that, or they tend to be driven into products that are more investment oriented and they're more expensive than just having term insurance. And sometimes they have it at work and they're able to increase the amount they have, but it costs something with the paycheck. Umbrella insurance, I think that's, where you have potential liability for a car accident, for example. And if you're working, and even though you don't have a lot of assets, your income might be at risk. So umbrella insurance that's offered generally through your car insurance carriers. And then here we talk about a 3-bucket approach. Again, you have the spending and you have the savings, but then you have taxes. So taxes is your 3rd bucket. So what I used to tell couples or people that are starting out in the workforce is that every time you get a raise, just assume 1/3's going to taxes, add to your lifestyle by 1/3, and save 1/3. And before you know, with those increases in income that you hope occurs over time, generally does, that you're saving more and more. And even though you're still having amounts that are coming into lifestyle so that you can enjoy. And then also here comes a meeting with advisors. And what I'm talking about here is your spouse. Very often couples tend to divide and conquer, or they don't really enjoy thinking about the financial aspects of things or taxes. But I think it's extremely important to empower your spouse to be aware of what's going on. I've seen a lot of cases where the other party doesn't have a clue. That can be dangerous for a lot of reasons. Something happens to your spouse, or you're not participating and you don't realize maybe you weren't saving as much as you thought you were, or you didn't know you had risky investments, or God forbid you're getting a divorce and now you're finding out everything for the first time. Next slide. So then we get into the later years, and this is obviously when we're in retirement, really close to retirement, really now adding up this nest egg and seeing what you have. Some things to be careful of is rules of thumb. And what I mean by here is people bring up all the time, like, oh, well, I should be more conservative. I'm 55 now. Shouldn't I have half my assets in fixed income? And you just heard from Alex how dangerous that can be, to just make those assumptions and not realize that you're going to live for another 30 plus years. And you really need to be very conscious of your withdrawals, the cash coming in, making sure your money lasts, not just in the dollars, but in the purchasing power, because inflation, when you do projections, you'll see what happens. Going through a spending analysis is important. And obviously we're doing projections for people so they know that they're not going to run out of money under certain scenarios, but then thinking about what you really can spend your money on. I just had a meeting with a client couple that is turning 80, and they've saved quite nicely. In fact, they're even still working a bit. And they said to me, actually, Alex, you were in that meeting. They said,
right. I know exactly.
You know what? We realized that we're never going to be able to spend all this money. I think it was challenging for them to spend and realize that they could spend. Maybe they didn't know what to really spend it on, or they were concerned in their early years, 60s and 70s, that they might run out of money. And so now I have to tell them that you're investing this money for the next generation. That's the reality of it. So it got us into a conversation about, well, I've got 2 grandchildren, for example, that are young adults, and one is pretty flaky. That's her words, not my words. And the other one is very, prudent and would be responsible with money. But I want to treat them equally. What do I do? Difficult conversation. And then you have their kids who they think are obviously the parents of their grandparents, and they're very thoughtful about how they want to give them money. And we talk about appreciated stock. We talk about, well, what are they going to use the money for? Are they going to invest it? We get into a conversation about this next generation, and they're getting ready to have a celebration this summer, a family celebration. I said, well, why don't you have a business meeting first? Would that be comfortable? Sit down with your kids and talk to them about your concerns as much as possible, find out what their goals are and objectives are, and then we come back to us and we can help you figure out a way to strategize. Does it make sense to have a trust? Does it make sense to give? Does it make sense to wait until, for grandkids, maybe you're helping them with a down payment on a house, maybe you're helping them be able to fund their retirement, all different types of things like that. But it is very important, I think, for people to realize that if they're not going to spend their money, then they're really investing for the next generation. Of course, we're doing tax planning all the time because taxes are real. If it's still going to be a third in retirement, we want to be very careful that we're strategizing year to year. We do know that taxes are dynamic too. We've seen a lot of changes. There may be other changes coming up with Biden and a new administration. And we want to be thinking about it ahead of time, but we also want to be making sure in real time that we're really paying attention to where their funds are coming from and trying to be as tax efficient as possible. So with that, moving on, the last slide that we have is just, if you want to see the article that I wrote back in 1996, you can go onto the link and take a look at that. So that's all I have. Thank you.
Thank you, Debbie. And by the way, the article is great. I read it myself, very well written and easy to understand. So especially if you have, children, doesn't necessarily mean very young children because it's for different ages. I highly recommend you check it out. It's a very well written piece. So please ask your questions. We still have a few minutes. I do have a couple of comments here because when Debbie and I were preparing for this webinar on rules of thumb, and for those of you who know me, and I know there are several of you who know me pretty well, I don't like them in general. In some cases, they're okay for, let's call it a casual conversation just to get the conversation started. But in many cases, they're actually based on nothing. One of my least favorite is when you take 100, you subtract your age, and the difference is supposed to be your allocation to stocks, not based on anything. So if you're a 55-year-old, right, so you take 100, you subtract 55, so presumably 45% of your portfolio should be in stocks. And again, maybe in the past, 10, 20, maybe 30 years ago, it made some kind of sense with bonds paying what they used to pay. At this point, you would effectively be keeping more than half of your portfolio, not just in cash-like investments, but also in types of in investments that may not even be risk-free at this point because of everything we've been discussing today. So be careful with the rules of thumb, especially if you're in this category, especially if those decisions will have significant impact on, let's say, your retirement years in this case. And then the other one, just again, sharing experiences in terms of given stock when we have conversations with our clients. Of course, if they just want to make a small gift to their children, we'll give cash, $50, $100. But anytime it's more significant, given stocks not just benefits them, of course, they want the money, perhaps they would get involved with, looking at the company, managing this account themselves. But it may also benefit you because essentially you're taking, again, perhaps a highly appreciated stock, you're removing it out of your portfolio. And let's say your grandchildren, in this example, perhaps, have no income, and if they end up selling the stock, they would pay nothing. Doesn't work like this way, but that's just one of the considerations.
Right.
All right. So I think we're good. I do not believe we have any other questions. That said, though, if, again, you have a question that you would rather ask in private, feel free to reach out to Debbie or myself. We would be happy to, first of all, clarify on anything we discussed today, if anything is not clear. And if you have any questions, we would be happy to address them for you. We do have a couple of events coming up. And by the way, we update this list relatively frequently. So there may be other events. We're actually thinking about a couple, but we'll have a certified non-profit accountant professional CNAP training program for those of you who are interested. We will be, in some sense, redoing or repeating our maximizing Social Security benefits and avoiding mistakes webinar. extremely popular, extremely popular. That's when we get a lot of questions, and of course, many people need to know about it. And in terms of the market updates, unless something drastic happens, that's when we'll definitely schedule something sooner than that. The next one will be on July 27th. That's when we'll talk about the third quarter, and then of course our thinking for the rest of the year. All right, we have our Coronavirus Resource Center. I have a lot of information, not just on the investment side, taxes, PPP. If any of you are interested, please check out our website. And yeah, thank you for participating in our webinar today. Greatly appreciate it.
Great. Thank you. Stay well.
Thank you. Bye-bye.
Bye.